Okay, let's start with chapter 1, the UK tax system. Now, when I talk about tax is nothing but a mandatory levy. What is it? It is a mandatory levy imposed by government of any specific economy. We are studying UK tax, so it will be UK economy. Okay, so UK government will be imposing tax on the businesses and citizens, or I would say residents of the country, that we would see in detail. Okay, so as I said, it is a mandatory levy by government, so as such you don't have option. Okay, if you want to pay tax, you pay tax, or else don't pay. You don't have any option. It is compulsory, it is mandatory to pay tax. If you don't, then you would have to face the fines and penalties and any other proceedings as per the law. Right. Okay, so it's obvious that government is kind of collecting tax from you. So why is government collecting tax? What is government going to do with this money? What is the purpose of taxation or imposing taxation? So one is economic purpose and other purpose is social justice. So let's first go through economic purpose. Okay, so the system of taxation and spending by government and its impact on the economy of a country as a whole. Okay, so when I talk about taxation, so let's say for example, you have 100 pounds of income. Okay, and let's say tax is 20%. So can I say you will have 80 pound in hand? This is nothing but your purchasing power, right? And let's say in second case you have again 100 pounds of income, but this time tax charged is only sorry, is 40 pounds. Okay, so can I say you will be getting in hand only 60 pounds to spend? This is your purchasing power. Okay, so usually government uses taxes to kind of impact the economy as a whole, you know, by charging tax. So let's say for example there is deflationary situation in the country. Okay, there is deflation in the economy. Then the government would also want to spend their money, right? So government would introduce some new development projects and all, right? Other than that, government will charge less tax. So people have more purchasing power. So if you have more purchasing power, you would be demanding more, and once you start demanding more, the economy will automatically revive, right? Versus in inflationary conditions, government will do opposite. Government would charge more tax, government would decrease their spending, right? So all in all economy, there will be lower spending, so resulting in lower demand, right? So bringing demand under control, right? So this way government uses taxation, right, to impact the economic situation of the country as a whole, right? Other than that, tax policies can also be used to influence many economic factors such as inflation, as already discussed, employment levels, and imports and exports. Now, when I talk about employment levels, so government can introduce some benefits, right? Other than that, for imports and exports, so for influencing imports, government may charge import duty. For, let's say, for exports, government may provide some benefits, or government may uh, let's say not charge tax, or I would say not charge tax on exports. That is your indirect tax, right? We will see indirect tax in detail. Okay, other than that, they are also used to influence the behavior of business and individuals, right? So how they invest, how they are spending money, right? In so government tries to influence the behavior of the businesses and individuals by implementing a few tax policies. Okay, we will be seeing these policies in detail in the chapters follow on. Okay. So how here are some of the examples, right? So UK tax system encourages savings habit among the citizen, right? Or I would say among the individuals. So how they do that? By introducing individual savings account. So in individual savings account, if you invest, okay, if you invest via individual savings account and you will be getting income from that, right? That income is tax free. That income is exempt from income tax. Okay, so this is one of the benefit. We will see in detail, no worries. right? Then other thing, so this will kind of inculcate a savings habit among the citizen, or I would say among the people, right, among the individuals. Next, charitable donations by offering tax relief, example through gift aid scheme. So if you donate, right, if you donate money, you will be getting some tax relief. Other than that, for investors and for entrepreneurs, right, for having a business idea, or let's say Shark Tank, so for investors, so they are kind of offering tax relief for investments, right? We will see that. Further, carbon neutral motoring by offering tax incentives on electric cars. Right. So if you use electric car, you would be paying less tax, right? Versus if you are paying or if you are using kind of high emission cars, yeah, I would say petrol cars or diesel cars, right? So in that case, you would end up paying higher taxes, or you would be getting less incentives from government. Other than that, the current UK tax system discourages. Okay, so taxes also used to kind of discourage people from doing some act. So motoring using petrol and diesel by imposing fuel duties. So that is approximately like 0.55 something pounds charged per gallon of fuel on petrol and diesel. So this kind of increases the price of petrol automatically, or and diesel, right? Making it expensive as compared to running cost for your electric car. Right. So this way government tries to discourage the use of petrol and diesel car and encourage the use of electric car. Second, smoking and drinking alcohols by imposing significant taxes on cigarettes and alcoholic drinks, right? So this will again make these two items expensive, right? Third, environmental pollution by imposing a variety of taxes such as landfill tax, climate change levy, and linking CO2 emissions to the taxation of the company car, so that people kind of do wastage sensibly, responsibly, right? While and make environment friendly decisions, right? So in order to influence the decisions of the individuals, right, these kind of levies are being imposed. Other than that, as government objectives change, taxation policies are altered, right? So if government, like, not in these things, but maybe in these kinds of things, yeah, let's say government is kind of thinking to make a spending economy rather than a savings economy, so they would kind of not discourage or not encourage savings scheme, they would encourage some spending scheme, right? If you spend here or if you invest here, you would be getting benefits, or you would be getting tax incentives or whatever, right? So that's the objective of every the objective of every other government may be different, right? For developing country, developed country, for underdeveloped country, right? Each government may be having different objectives, and accordingly, tax policies have been are being drafted. Okay. Further, social justice. So, type of taxation structure imposed has a direct impact on the accumulation and redistribution of wealth within the country. The main taxation principles are listed below. Okay. So, usually, government kind of charges higher taxes for high earners and uses that money to provide services to everyone, right? Or I would say building infrastructure, yeah, administration, or else making schools and government hospitals. But these government hospitals are usually used by middle class people, right? So the riches who are actually paying the good amount of taxation are kind of not using that service, but kind of, or I would say only some percentage of people are paying huge taxes, versus all are using that service. 100% of the people, or more than 50% of the people are kind of using that service, right? Okay, so in all around the world, your taxes are broadly based on these principles. Okay, so let's see each of these principles one by one. First is progressive taxation. So higher the income, higher will be the tax. Okay, best example is income tax. Okay, so income tax in UK, first slab is for 20%, then next slab is for 40%, then third slab is for 45%. So more you earn, more you end up paying taxes. Okay. Second is regressive taxation. In regressive taxation, the more you earn, your tax falls as a percentage. So For example, the tax on liter of petrol is same regardless of the level of income of the purchaser. So let's say, for example, there is one CEO. He is having like 2 millions of his income. Okay. And there is one normal employee, normal, let's say, accountant. Okay. Junior accountant. He is having a salary, or I would say pay of 30,000 pounds. Right. Now let's say the CEO and this junior accountant both live at the, both are kind of neighbors. Okay. So and both use their car to travel from home to office, right? And for let's say it's around 10 miles, okay, from distance from home to, or I would say house to office. Okay. And let's say, for example, levy by government, or I would say fuel duty by government, is kind of 1 pound per gallon. Okay, so both CEO and junior accountant both are paying 1 pound per gallon, and let's say they consume around 10 gallons in a month. So can I say they both end up paying, or I would say 100 gallons in a month. Okay, so they both end up paying 100 pound. They both end up paying 100 pound. But if I compare with their income, even this is a tax. This is the kind of tax, right? Both are paying same amount of tax, right? Now, can I say Mr. CEO is paying 100 pound, but he is having 2 millions of income. So can I say as a percentage of income, Mr. CEO is only paying 0.005% of, I would say, fuel tax or fuel duty as compared to his income, versus Mr. Junior Accountant is paying 100 divided by 30,000 K into 100, that is 0.33%. Getting it? So higher the income, lower is the tax as a percentage. Of course, amounts are same here, right? Okay. Next, proportional tax. The proportional tax remains the same irrespective of total amount of which it is based. Example, 10% of all earnings regardless of the amount. Okay. So in this case, your percentage is same. So let's say, for example, corporation tax. Okay, corporation tax. It is a tax on company. Okay, so corporation tax. Let's say, for example, one company is having 2.5 million of profits on which tax is applicable, and one company is having, this is company A, this is company B. Company B is having, let's say, 25 million pounds of tax. So both the companies would end up paying 25% as tax. So proportion of the tax remains the same, irrespective of the total amount of which it is based. So irrespective of whether you are earning 2.5 or 25 million does not matter. You both would end up paying 25% of tax, both company A and company B. So whatever your income or higher the income, same is the proportion of tax. No change, same proportion. Okay. Fourth is your ad valorem principle. Tax calculated as a percentage of the value of the item. For example, 20% VAT on most goods sold in the UK. Okay, so this is a kind of tax charged on the value of the item. These three were based on income, income. Okay, versus this, or I would say ad valorem principle. In ad valorem principle, tax is calculated as a percentage of value of the item. So for example, 20% of VAT on most goods sold in the UK. Okay, best example is VAT. This is a kind of indirect tax. We will see this in detail. I hope till now it is clear. So these are the principles. Mostly all around the world, taxes are based on these four principles. Okay, they revolve around these four principles only. Okay, okay. Moving ahead, types of tax. So in UK, see, when I say government will be charging tax, that doesn't mean the prime minister or president will be looking after the tax matters of the country, right? They have other works too, right? So there are kind of departments which are responsible for the administration of the taxes, right? In every other country, not only in UK. So in UK, the department that is responsible for the administration of taxes is your HMRC, that is HM Revenue and Customs. Okay, HM Revenue and Customs or HMRC, you can use both of them in your exams. That's perfectly fine. So it is HMRC, which is responsible for the tax administration in UK. It is a kind of tax department of UK. Okay, wherein HM stands as Her or His Majesty. Okay, that depends on the crown holder. Who is the crown holder? If the crown holder is the king, then it will be His Majesty. If the crown holder is her, then it will be, I mean, queen, then it will be Her Majesty. Okay, so you can write in exam HMRC, that's perfectly fine. Okay, further talking about types of taxes. So types of taxes for your syllabus are income tax, national insurance contribution, capital gains tax, inheritance tax, corporation tax, and VAT. Okay, value added tax. Okay, so let's see each of them one by one. Income tax is charged on individuals on their taxable earnings, that is through self employment or employment. So whether you are a sole trader or whether you are doing a job, okay, or whether you have made some investments and you are earning kind of savings income or kind of dividend income, right? So you would end up paying income tax on that. This is only for individuals. Okay, so tax on individuals on their earnings is income tax. Next, national insurance contribution. Now UK is having kind of one of the largest network of government hospitals, okay, which is called as National Healthcare Services, NHS. Okay. Now, NHS is kind of having a huge spending. Okay. And it is not possible to fund these spendings through income tax or capital gains tax or any other tax. So they have a specific tax called as National Insurance Contributions. Okay. The funds from these are used to fund the operations of NHS plus provide pension to old age people. Okay, so for that particularly is the national insurance contribution. So national insurance contribution or NIC, you can write it NIC, that's perfectly fine, is payable by individuals who are either employed or self-employed on their earnings and also payable by businesses. So individuals and businesses both are paying NIC. In this case, only individuals are paying income tax versus NIC is paid by both individuals and businesses. Okay. Next, capital gains tax. So this is a tax paid by individuals on disposal of certain capital assets. Okay, that may include your land, buildings, shares, or can include smaller items, antiques, or any other thing. Right? So on which you are kind of having gain. Okay, it is not earning. When I talk about income tax, it is on earnings. So this is kind of recurring transaction. Okay, revenue nature of transaction. When I talk about job, okay, you will be getting your monthly pay every month, right? When I talk about self-employed, you are trading, so you would be getting profits regularly, right? The amount may be up or down. That's sometimes it may be loss, sometimes it may be profit, but this is something a recurring transaction. Versus when I talk about capital gains, can I say capital gains is something which you do once in a while, once in a year, twice in a year. You don't do it that much frequently, right? Further, inheritance tax. Again, this is only on individuals. Capital gains tax is again on individuals, not for companies. Okay. Next, inheritance tax. So it is payable by personal representatives on the value of the estate of the deceased person and also payable in respect of certain gifts during an individual's lifetime. So whenever you inherit something, let's say for example there is a father and there is a son. Okay, so father died and a kind of his death estate, right? He must be having some shares, he must be having a house, he must be having a car, right? He must be having some pension fund, right? All these things are transferred to his son and let's say his son and daughter. Okay, both of them 50-50. So can I say this is a kind of legacy which is passed on, right? And this is inherited by son and daughter. So on that inheritance tax is being paid. Other than that, not only on death, let's say for example, during his lifetime, father was alive, is gifting something to his son, to his daughter, to his spouse, to his some any other relative, friend, anything, right? So on that, inheritance tax applies. Next, corporation tax, payable by companies on their incomes and gains. So for individual, it is income tax and capital gains tax. But for companies, for both incomes and gains, there is only one tax, that is corporation tax. Getting it? Right. So on incomes, that is profits and interest income and any other income, and on gains when they sell shares or maybe any building or any premises or any machinery, right? So they must be making gains, right? So companies end up paying corporation tax on both the things. And last one is your VAT, which is payable on supply of goods and services by the final consumer. So end bearer of the tax is the final consumer. Okay. So VAT usually works like, let's say for example, there is a business, let's say for example, restaurant. Okay. And this is government, or I would say HMRC, the tax department of government. This is restaurant, and there is an individual. Okay. Now, this individual went to this restaurant to have some meal, and he paid VAT on that. Okay. And this VAT is eventually paid to HMRC by the restaurant. So, wherein this restaurant acts as an intermediary. This restaurant is acting as intermediary because ideally this individual is paying tax to HMRC ultimately, right? Only this restaurant is kind of a middleman, an intermediary. Restaurant is acting as an intermediary. So liability to pay tax is with the restaurant, but the brunt of that tax is borne by that individual. So this is the system of VAT. So when I talk about VAT, can you see that individual is not directly paying to HMRC? Individual is paying tax to HMRC via this restaurant, via this intermediary. Hence, VAT is an example of indirect tax. VAT is an example of indirect tax. Okay. Versus when I talk about any other taxes. Okay. When I talk about all the five taxes, that is income tax, national insurance contribution, capital gains tax, inheritance tax, corporation tax, there is no intermediary in between. Okay, the taxpayer, whoever it may be individual, it may be company, the taxpayer directly pays the tax to HMRC directly, no intermediary. So, since there is no intermediary and tax is paid directly, all these taxes, all the five taxes are example of direct tax. What are the example of direct tax? So, everything. This is DT, this is direct tax, this is direct tax, this is direct tax. Only that is indirect tax. Okay. Further, tax is also divided based on nature of transaction. Okay. So transaction can be of two types. One is revenue and other one is capital. Okay. So when I talk about income tax, can I say earnings are something which is regular, something which is recurring, something which is revenue in nature, and hence it is an example of revenue tax. Okay. So income tax is nothing but revenue plus direct. Okay. Direct type of tax, revenue and direct type of tax. National insurance contribution. Again, national insurance contribution is paid on your earnings, right? So again, it will be revenue in nature, and again, it is a direct tax. Okay, third, capital gains tax. As the name suggests, capital gains on capital assets. So definitely it will be a capital nature of tax. So capital, and again, it is also direct tax, right? So it is capital and direct in nature. Next, inheritance tax. It is payable by personal representatives on gifts or on death, right? So people don't die every day, right? Versus not even people gift every day, right? So this is not something recurring transaction, right? Hence, it is again capital, and again it is a direct form of tax. Further, corporation tax. Corporation tax is on income and gains both. Oh my God. Is this revenue, or this is capital, or is this both, or is this neither of them? So in this case, it is your revenue and capital both. Corporation tax is an example of revenue and capital both. And again, it is direct in nature. Last one is your VAT, right? Now, VAT is neither charged on income nor charged on gains. It is charged on supply. Hence, it is neither of both. It is nor revenue nor capital, and it is an indirect tax. Okay. So now moving ahead, we have already discussed this direct and indirect taxation. Okay. Let's try to understand the structure of UK tax system. So HM revenue and customs. That is HMRC is the government department that controls and administers tax within the UK. Right? We already saw that. The purpose of HMRC is to make sure that the money is available to fund the UK's public services, right? That is your rail network, your bus network, your hospitals, your schools, and any other thing, and help families and individuals with the targeted family financial support. That is your kind of child benefit and everything. Right? We will see this in detail. Okay. Next, talking about the structure, so heading up HMRC are the commissioners whose main duties are to implement the statute law and to oversee the process of the UK administration. So these are kind of heads. Okay, heads of HMRC are called as commissioners. Okay, and their responsibility is to implement the statute law. That is your law. That is your Income Tax Act. That is your VAT Act. Right. That is your Corporation Tax Act. Right. That is your Inheritance Tax Act. Right. So so the commissioner's responsibility is to implement this statute law, these acts, right? Different acts, and to oversee the process of UK administration. Okay, so these are kind of CEO. Okay, they kind of look after the operations of the HMRC. Next is the staff who works for HMRC are known as the officers of revenue and customs. These are kind of employees of HMRC. Okay, the name is officers of HMRC. Okay. Next, HMRC have offices located all over the UK, many of which have specialist functions such as dealing with international businesses or large companies. Okay, so there are different offices. So one office may be general office, other one would be like specifically for VAT, or specifically for large companies, or specifically for with respect to international taxation matters, right? So that's different offices located in the UK. Then most taxpayers will never deal directly with the local tax office as HMRC encourages taxpayers to file tax returns online, use their website to answer queries or telephone or email a number specialist helplines. Example, the self-assessment helpline. Okay. So usually most of the taxpayers deal directly with the uh, deal directly through the HMRC website and or either local tax offices. Oh, sorry, they will never deal with the local tax offices. Taxpayers directly go through the website and raise their queries or file their returns and pay their taxes and all that stuff. Okay. So taxpayers are kind of encouraged to file their tax returns and pay their taxes electronically, digitally, right? that is both for companies and individuals. However, individuals can kind of submit paper returns, that is their offline returns in a paper form, right? Non-digital form. Okay. Further, under self-assessment, the responsibility for reporting the correct amount of taxable income and paying the correct amount of taxes delegated to the taxpayer to self-assess. Now, when I talk about all taxes, okay, all the taxes in UK are kind of based on self-assessment system. Okay, so wherein you determine what is your income and you report that to government and compute your tax by yourself and pay the tax accordingly. So I am self assessing myself, I am assessing myself. So it's just like you are writing the paper and you are correcting it. Okay, though this doesn't happen in real world, but in tax world it happens. Okay, so you whatever you have earned during the year, you kind of total it up and report that figures to HMRC with the relevant proofs and all. Okay, and pay tax accordingly. Okay, you compute it. The onus is on you. The responsibility is delegated on you by HMRC. However, the officers of revenue and customs can still be requested to do the calculation of tax payable based on the income reported for the individual taxpayers, but not companies. So individuals can request HMRC to compute it, or else if you use the website, so website has automatic calculator kind of thing, right? So all you need to do is input the figures, your salary, your gross pay, this, that, right? Every other figures, your spendings, your investments, all that stuff, and accordingly HMRC will kind of give you the figure of tax liability that is supposed to be paid. Okay, so that website would give you the figure. Okay, moving ahead, sources of tax law. So, what are the sources from where HMRC is getting this power to charge tax, right? They are charging six taxes in your syllabus. Actually, there are more than that, but for your syllabus there are six taxes. So, how is the HMRC getting that power to charge tax? What should be the percentage? Which should be included in income? Who will be the individual? Which individuals would be liable to income tax? Which companies would be liable to corporation tax? Okay, which businesses would be liable to VAT, right? So how all these are determined? Who is giving them power? So the what are the sources of that law? Okay, that govern the tax within the UK. So these are kind of sources. So let's see each of the sources one by one. Source number one, the statute law, that is your tax legislation, that is your income tax act, that is your value added tax act, your inheritance tax act, right? So this is the law, right? Along with that, the tax legislation is normally updated each year by one annual finance act that follows from the proposals made by the Chancellor of the Exchequer in his annual budget statement. Statutory instruments are issued where detailed notes are required on the area of tax legislation. Okay. Now, when I talk about, let's say, for example, Income Tax Act 2007, ITA 2007. Now, see, Tax Act was made in 2007. Today it is 2025, right? So things would change, right? So if things are changing, can I say the act needs to be updated? But not everything, not 100% is required to be changed, right? Based on the economic objectives of the government only wants to change few things, right? So for that, they would issue Finance Act. Okay, Finance Act is nothing but a kind of, you can say, supplementary document to the Income Tax Act. So you cannot read Income Tax Act solely. You need to read Income Tax Act along with Finance Act for that relevant year. Okay, so for your syllabus, your exams, the relevant Finance Act is Finance Act 2024. Now, when I talk about 2024, so this is the starting period. So usually Finance Act is applicable from 1st of April 2024 to 31st of March 2025. Okay, so this is the Finance Act, and this is something which is applicable, and FA 2024 is applicable for you for your exams, right? So we will be using that. So you need to read both to determine what the law is wanting to say. Okay. Next are the case law. Now, when I talk about law, your Income Tax Act, your Finance Act, so now these are kind of principle based acts. Okay. It doesn't say what is to be done in what particular situation. It just gives a particular principle on based on that principle you can use your professional judgment and apply the law, right? So here can I say the judgment would be subjective. It would change from individual to individual. One individual may have separate understanding, another individual may have separate understanding of the law, and HMRC may have separate understanding of the law, versus the tax maker, the lawmaker, I would say law, not tax maker, the lawmaker may have a different interpretation, or I would say intention regarding that law, right? These guys are just trying to understand what this person, whoever has made the law, right, lawmakers intention of implementing that particular act, right, or section of that act, right? So there may be kind of issues in interpretation of one person to different person to HMRC, right, thus resulting in different interpretation, hence different taxation, different tax amount, right? So that creates the dispute, right? So these disputes may go to the court of law, and court of law may provide a judgment, right, regarding the interpretation of that particular section, right? So such interpretations become case law. So if next time such issue has come to the court, okay, same issue which was already addressed by some other court, okay, and same issue comes to the court or by other judge, right, same issue comes to the court, then court would rely on that specific judgment if the situation is same, if the scenario is same, obviously, right? So that case law will also become a kind of source, okay? So Income Tax Act, Finance Act plus case law. So if there is a case law for specific section of the act regarding the interpretation or regarding the application of it, right? So even that needs to be read along while reading income tax, while reading finance act, right? So in order to get the understanding of the income tax, okay, or I would say any other act or law. Further, HMRC guidance. So, kind of HMRC also issues its guidance with respect to some complex or any topics which are prone to some misinterpretations, right? So, for that, HMRC kind of issues guidance, right, in order to explain how to implement the law or how to apply the law and how to interpret the law, how to understand it, what the lawmaker was trying to say, right? So, application and interpretation, both. Okay, so main types of guidance are listed below. One is your statement of practice. So this provides HMRC's interpretation of law, how HMRC is interpreting or how HMRC is trying to understand the law, and also provides clarification or detail of how rules should be applied. That is your application, how to implement, how to apply, and how to interpret. Okay, that is your statement of practice. This is issued by HMRC. Further, there are some extra statutory concessions. Okay, so HMRC kind of issues ESCs, that is extra statutory concessions, that allows a relaxation of the strict letter or strict application of law. Okay, letter is nothing but the words of law. Okay, so HMRC can make an ESC to administer the tax system fairly and effectively, but cannot counter the clear words of the law. So HMRC may kind of give you concession, or not you in particular, a specific class of businesses, or let's say a specific class of taxpayers, right? For them, ESC may be implemented or may be kind of released by HMRC, right? So an ESC confirms that HMRC will apply a tax law to a specific group in a more favorable way because it is just unjust, okay, or it is illogical, or it is unfair, or it is creating undue hardship on the taxpayers, on that particular class of or group of taxpayers. Okay, so that way, HMRC may apply ESC, or HMRC publishes current ESCs, and all taxpayers in the stated situation can rely on these. And it is government policy for the content of the issued ESCs to eventually be withdrawn or enacted into the law. Okay, so it is the government decision if they want to adapt that into the law itself, right? Or else they want to withdraw it because the situations have now improved. So they don't want to apply it any further. Other than that, there are internal HMRC manuals. Now, as the name says, internal, these are kind of manuals for the staff to give them guidance on the interpretation of the law. Though they are also available for the public, but main intention of these manuals are for the staff. Other than that, HMRC has their own website. They have some leaflets and booklets which are aimed for general public, and it provides explanation of various tax issues in non-technical language, in layman language, in common man's language, easy to understand language, right? Versus when I talk about detailed technical guidance, now as the name says, technical guidance. So HMRC issues notice and guidance notes aimed at tax agents or advisors or tax consultants, right? Who are kind of experts of tax, who have understanding of the tax, who have read tax or understood the tax or do apply the tax in their day-to-day life, right? Or to keep on advising on the tax. To explain tax issues in more technical detail than in normally required by the general public. So these are kind of people, you and me, okay, who know tax or who are learning or who are able to apply the tax, right? So HMRC briefs provide detailed guidance, technical guidance on specific tax issues that has arisen in the tax year. Okay. So this is for the tax agents and tax consultants and advisors. Okay, moving ahead. Interaction of UK and overseas tax system. It is possible for individuals and companies to be resident in both the UK and another country. The rules that determine tax residency status are covered in detail in chapter 3. Due to differing tax systems in overseas countries, it is possible that income is taxed under two different systems and therefore subject to double taxation. Okay. Now, when I talk about, now this is something which is out of your syllabus, but I think this should be known by you. Okay. So, in the world, taxes are usually charged based on two concepts. One is your residential status, and other one is the source of that income or gain. Okay. So, one is your residential status of that individual or of that company or of that business. Okay. Versus what is the source of that tax? Now, let's say, for example, I am kind of living in Germany. Okay. And I am working for a UK based company. Now I am living in Germany, so definitely I am resident of Germany. But can I say my source of income is in UK? Because UK's employer has hired me. I'm kind of working from home, remote working. So now in this case, the source is in UK and residential status is in Germany. So who will be charging tax? Will it be Germany or will it be UK? Right? uh, because there is a possibility that each country may have different types of taxes, charging tax based on residence or based on source or based on both, right? So now what to do? So to tackle these, there are kind of, now there is a possibility now on my same income, Germany may also charge tax and UK may also charge tax. So that would result in, can I say, double taxation for me, for an individual or for a company or for any other taxpayer, right? On that same £1,000 earned in Germany, I am paying tax in Germany, or sorry, earned from UK, I am paying tax in UK also and in Germany also. So can I say I am facing double taxation issue, right? So to avoid that, usually governments kind of sign a double taxation agreements. So these agreements are between most of the countries, and UK has signed kind of agreements in most of the countries, which have been established to decide how a particular individual company should be taxed. They should be taxed based on residential status or source based. Right. So that details are provided in the uh, double taxation agreements with the respective country. So these are known as bilateral double taxation treaties. Okay, such treaties take precedence over over domestic UK tax law and either exempt certain overseas income from UK from tax in the UK or provide a relief where tax is suffered in two countries on the same income. So either it will make exempt. Exempt means no tax is to be applied on the overseas income from the tax in the UK, or provide relief where tax is suffered in two countries on the same income. So let's say, for example, the tax is already paid in UK, so for that amount of tax, relief will be provided to in Germany if such agreement is there. Where no such agreement exists, where no such treaty exists, the UK system still allows for relief to be given where double tax is paid. Double taxation relief is for individuals and companies, is not examinable. Okay, so let's say for example, now what does this means that UK still allows? So let's say for example, I'm switching this. Okay, let's say I am resident of UK and I am having source from Germany. I am now working for German company. Okay. So my source of income is from Germany and I am resident of UK. So UK government is will be charging me taxes, right? Because I'm resident, but I'm also having income from Germany. So let's say I'm kind of 1000 euros. Okay. I'm earning 1000 euros from Germany, right? So let's say German government is charging me 10% on my earnings, right? And let's say UK government charges 20% of tax, right? So UK government will still allow for a relief to be given where double taxation is paid. So can I say here I am paying double taxation? Let's say UK and Germany is not having any treaty. Okay, they do not have any treaty, double taxation agreement. Okay, so in this case, can I say I would end up paying 10% here, that is £100 or €100, whatever. And can I say 20%, that is 200? So can I say I am paying 30% of tax, £300, that is 30% due to double taxation. So what will UK government do? UK government will give me UK government will say that my liability is 200, right? So UK government will provide me a unilateral relief on the tax that is already paid in Germany, £100, right? And accordingly, only £100 will be required to be paid in, or €100, whatever, will be required to be paid in UK. So ultimately, I will pay 100 in UK and 100 in Germany, 100 in UK and 100 in Germany. Okay, this is only the case in UK. Let's say different scenario. I'm switching the percentages. Germany is charging 20%, and let's say UK is only charging 10%. Now what? Now, can I say liability of yours is 100 and you have already paid in UK and you have already paid in Germany 200. So will you get refund of 100? No. So if UK tax is higher than any other country, then UK government will provide you relief for the amount that is paid already in some other country. But if UK tax is lower than any other country, then UK government will not pay refund because you haven't paid anything to UK government. Then why should UK government give you refund? So maximum it can go to zero, or I would say minimum it can go to zero. It cannot go to negative as such. Okay. Next, moving ahead, tax avoidance versus tax evasion. The difference between tax avoidance and evasion is important due to legal implications of the same. When I talk about tax evasion is kind of trying to save your tax or reduce your tax liability, but by illegal means. So best example can be suppressing information, as we discussed. It is self assessment tax, right? UK tax system is based on self assessment. So you need to assess your income, you need to assess your gains, and you need to pay the taxes on the same, right? So if you fail to declare any taxable income to HMRC, then obviously this will be considered as tax evasion because this is something illegal, because onus is on you, responsibility is on you to declare all your income, right? Or else submitting false information, that is claiming expenses that have not been incurred. So let's say for example, claiming false bills or using false bills to claim false amount of expenditure and hence reducing your income tax liability, right? So this is kind of a forgery. Okay, so since you are kind of doing tax evasion, this is illegal activity, so there is also a risk of criminal prosecution. Okay, so there is possibility of fine or imprisonment or both, and so you may be fined and you may also need to go to jail. Okay, versus tax avoidance. Now, when I talk about tax avoidance, is using the taxation regime, using the tax law, okay, to one's advantage to minimize the tax liability. This is also referred to as tax planning. Okay, it is legal, it is perfectly fine. and does not entail misleading HMRC. Example, making tax savings by investing in ISA. So government is wanting you to invest in ISA, and you are investing in ISA, and the earnings earned from that ISA is tax free. So this is not tax evasion, this is tax avoidance. You are using tax law for better planning of your taxes. So as a tax advisor, even in your exams and even in your real life, we need to focus on tax avoidance. Okay, in the form of tax planning, of course, not rigorous avoidance. Okay, not um, taking undue advantage of law, unfair advantage of law. Okay, or misusing loopholes in the law. Okay, not that. In a form of tax planning, we would that will be your responsibility as a tax advisors or as a tax consultants or tax agents. Okay, and even the question you would be getting some similar kind of tax planning point of view questions. The term is also used to describe tax schemes that utilize loopholes in the tax legislation. Okay, but don't take undue advantage of the loopholes. So TYU 1